There are three standard ways of producing money, aside to excluding debt and leverage. So the first is capital. So what is capital? So capital is essentially any resource that is owned by a business and is useful in generating income. So it could be, for example, funds that are raised by the business or accumulated wealth by the business. Or also, it could be stocks or something that is owned by the business. There's a distinction between capital and money, because money is actually something that is immediate, that is liquid, that you can use for the purchase of things. So the capital is those resources that are useful for the actual growth of the business. Now the second is equity. So equity is essentially your assets less your liabilities. So all the total assets less all outstanding or total debts for their company that are associated with the company. The difference of that would be your equity. So equity will come in different forms. This could be your stocks, for example, that can be equity as well. And in property is essentially the difference between the value of your property and the debt on the property itself. So it could be a mortgage that you own. So the difference, if you have a property that is 100,000 and you've got a mortgage of 75 on it, your 25 will be your equity. Now, the third is income. So this is the third way of producing money, and that's income. So income is basically money received by a business for work that it's done. Or for investments in its assets or capital, for example. There's different income streams. So for those people who are working, so exchanging their time for money, the income stream will come from the wages. So those are employees. You can have net cash flows associated from sale of assets or investments. So that's also income coming in. For those who have, sang songs, for example, you can have income from royalties, as well as residual income or passive income from assets such as property that you own. So those are the three ways of producing money. So from the capital that you own, from equity, and from income. So why is this important to understand? Because it is important to have a balance in each of these three areas of producing income. So there's no point just having a lot of capital or equity but no income, because your income, your money, is where things are a bit liquid. So it is the liquid form of your income. So you want to use that for your daily purchases of things, So it will be difficult for you if you just have capital to run your day-to-day activities, such as if you have employees to pay wages and all of that. On the other hand, if you only have income, it means that you don't have those cash-generating capital or assets which will generate you that income over a consistent period of time in the long term. So if you run out, for example, if you're an employee, you spend all your money and you can't work anymore, then you're stuck. But if you have assets, then those assets will be generating you that income for you to carry on. But if you, on the other hand, if you also on the other extreme, you own assets which are not generating you that income, probably because you own them for the capital growth over a period of time, such as pieces of art, for example, then you don't have that income as well. So it is important to strike that balance between your capital, equity, and income so that you can continue operating and keep that balance, so that you can operate effectively and efficiently in achieving all your goals. So I hope that is quite a useful basic understanding of the three ways of producing income, which is your capital, your equity, as well as your income. So I hope you go out there, experience, learn, and grow. Until next time, cheerio.